You've said that it is going to be more challenging to achieve the 2019 and 2020 profitability targets, but you've kept the targets. Can you square that circle for us?
Again, so our return on tangible equity in the third quarter was in double digits at 10.2%. In 6 of the last 7 quarters now, we've generated a return on capital of over 9%. You know, I think we still feel pretty good about the 9% target for 2019. I think what we're bringing up is, as you look into 2020, you've got the macro environment in the UK, where I think economic growth is somewhat muted. And if we continue with the uncertainty of Brexit, I think one has to think that you will continue to have soft growth in the UK. But also we have lower interest rates. And the lower interest rate environment clearly puts pressure on a bank's net interest margin and on the profitability of its deposit base. So given the current interest rate view across Europe and the UK, now in the US as well, and if we have economic softness, we need to put some caution against the 10% target for 2020, but we're still going to maintain that target for now.
What do you expect in terms of Brexit right now, Jes? I mean, would you welcome an election in the sense that it could put an end to all of this uncertainty?
You know, what we've said over the last couple of days and weeks, what we're hoping for is an end to the uncertainty. I'm not going to make a position from the bank, whether it's this type of deal or that type of deal. But getting uncertainty behind us and allowing the financial system and the banking system to begin to execute with an idea of what the future is going to look like, I do think that's important. I do think that's important for the country. So I think the one vote in Parliament that voted in favor of a deal that the European Union had also been supportive of, I think that was a good step forward. But obviously we have uncertainty now. It may lead to a general election, and we'll have to see how that plays out.
So the uncertainty around Brexit, I mean, you've been saying this morning that UK consumers have been moving to cash amid the uncertainty, but that UK credit is benign despite some of the Brexit headwinds. What about the global credit cycle, Jes? Do you get a sense that that's starting to turn?
No, not yet. I think the level of overall debt, whether it's sovereign debt or corporate debt, we all need to keep an eye on. With interest rates as low as they are around the world, and in Europe you have trillions of dollars of sovereign debt that are in negative interest rate territory now. That's going to take the pressure off the credit markets. But what we have to be wary of is, if for whatever reason the tight labor market, and we've got to recognize that unemployment is quite low in many places like the UK and in the US, if that tight labor market ever really did deliver inflation and we started to move on interest rates, the level of overall debt, I think, would be something that would be quite difficult to manage. But right now, with unemployment low, with inflation low and interest rates low, the credit market can appear on the surface to be pretty benign, and that's what we're seeing.
So how do you like your leverage loan business right now then, Jes? Because a lot of banks are at least increasingly concerned about getting hung out to dry with the loans they can't get rid of.
So we, very much like the team that manages leverage finance for Barclays. They've had a very good year. I would characterize the environment in the following way: if you have a solidly structured deal, the market is quite receptive. So there is liquidity out there. There's a lot of funding available for the leveraged finance market. What we've seen recently, however, is if you have a deal that's not structured properly, that has some idiosyncratic weaknesses to it, the market can be pretty punishing at the bottom end. So it's a market that you have to have your eyes open to. You can still get the strong deals done. We're very comfortable with our portfolio, with our performance in the third quarter. But a couple of idiosyncratic deals, I think, have opened people's eyes that it's not a free ride right now.
Jes, how happy are you with equity and FICC trading this quarter, particularly versus the US peers, which did better than expected on a number of fronts?
Again, we're very pleased with our markets performance. Up 13% year over year. I think we look quite good compared to the U.S. peers, and let's see how our European peers do. But we continue, in our view, to gain market share. We had a very good quarter in terms of investment banking fees, up 24% year over year. It was actually, in terms of M&A advisory, debt capital markets, and equity capital markets, the strongest third quarter in the history of the bank. So I think we're making progress in investment bank. We like the diversification benefit that the business gives us. We like the diversification business that's very heavily weighted to the U.S. and the U.S. dollar. So the corporate and the investment bank, I think, delivered quite a strong quarter for us.
Yeah, the whole CIB revenue was much better than expected, as Nejra pointed out earlier. But if you had to look at one unit, Jes, when you wake up in the morning, which opportunity in the investment bank do you really get excited about? What do you think is the best opportunity in IB for Barclays in this economic environment?
I think the characteristic that I'm feel best about when I look at the investment bank is that we are across all all asset classes in all markets, and I don't think that you can pick and choose a vertical in an investment bank. You need to serve the full range of the buy-side clients. You need to offer your corporate clients the full range of advisory, debt capital markets, equity capital markets services. And I think we do that. And I think right now we have a bulge bracket investment banking position in New York, a bulge bracket investing position in Europe, the two deepest capital markets in the world. I think we are, a strong European alternative now to the U.S. banks. Feel quite comfortable that we can compete with them. So I like how we're positioned in the IB and the breadth of our business model.
Jes, can you give us an update on cost cuts? Because we understand today that you are still targeting those cost cuts below the lower end of the range. How are you expecting to achieve that?
So if you look at our run rate cost basis, we're well on our way to delivering 13.6, if not slightly below 13.6 billion pounds of cost for the year. As you pointed out, that was the low end of our range. So I think we're managing our costs well. So long as we maintain the profitability of around 9%, we're very interested in taking our efficiency gains and our cost reductions and reinvesting them in the business. We just got voted the #1 mobile banking app in the UK. We have 8.5 million consumers that go on that app every day. We've been rolling out new trading algorithms across the investment bank this year. We have a new corporate banking platform for Europe. That's all investing in technology to take the bank forward. So we like our cost basis here at around 13.6. And from here on, I think we want to invest our cost savings so that we can grow the top line. And I think what we did in the third quarter, which beat the street estimates, is really in the top line on our revenue, and that's a healthy thing. I don't want to surprise in profitability by cutting more costs. I'd like to surprise in profitability by growing the bank.
Yeah, I wonder what your take is on market share, especially here in Europe, Jes, because U.S. competitors continue to report that they're taking market share, and the bank behind me, Deutsche Bank, obviously is in a position where it needs to cut costs, maybe more than its competitors. Are you in a position to take some of that share that's being left on the table?
One of the things that we keep an eye on is our prime brokerage business, which is basically the connection of the bank to financing the buy side, hedge funds, mutual funds, et cetera. Our prime balances for equities is up over 20% year over year, and our prime balances for credit is up over 70% year over year. So we're gaining share in the prime brokerage business. I think that leads to more trading volume across the desk, and I think we're doing quite well and quite competitively against the U.S. firms.
Jes, if trading remains solid and the rally in the pound holds, of course, there's a lot with Brexit to do with that. What is the guidance for bonuses?
It's very important that we deliver a good level of profitability. The CIB itself had an ROTE in the third quarter over 9%. We want to pay fairly and pay competitively, but also I think everyone in the corporate and the investment bank recognizes that we have an obligation to our shareholders to deliver an acceptable level of profitability, and that's what we're going to do.